Welcome. It's great to have so many people joining us for this AE Business Advisor webinar. My name is Leah Heel and I'm the Engagement and Partnerships Lead here at the Pensions Regulator. I'd like to start by thanking those of you who took part in last year's survey, where we gave you the chance to select your preferred webinar topics. We've put together today's agenda to reflect those top themes, and these include assessing staff, re-enrolment and calculating contributions, which my colleagues Mel Charles, Director of Automatic Enrolment, and Andy Nichols, Payroll Industry Liaison Manager, will take you through. Towards the end of the webinar, there will be a Q&A session, and this is your opportunity to ask us any questions you may have. You can start submitting your questions now and throughout the session by typing them into the box below this video player. As ever with our webinars, please don't worry about capturing all the information yourself. The slides from today's session will be available for you to download after the webinar, along with our useful links document, and a recording of the webinar will be available to view again in a few days' time. We've added links to the slides with icons as a key to help you quickly assess further information. Guidance can be found on our website under the Employers and Business Advisor Guides. You can also find our detailed guidance on automatic enrolment in the document library. And there's also an opportunity for you to feedback on the session itself. The survey is now available at the top of the menu to the left-hand side of the video player. We'd be grateful if you could fill this out before you leave, even if you can't stay with us until the end. I'd now like to welcome my colleague Andy Nichols, Payroll Industry Liaison Manager, to kick off our first topic. Over to you, Andy.
Thanks, Leah. As advisors, you most likely play a key role in helping employers comply with their AE duties correctly. And this is particularly true for new employers. Our research shows small and micro employers will ask you for advice in choosing a pension scheme or carrying out the assessment for staff, especially if you provide payroll services. Your support can help employers avoid making mistakes, so they correctly carry out their legal duties and staff can save for retirement. So one of the first ways you can help employers is making them aware of their legal duties and establishing which duties you can help with and which ones they will be responsible for. Noting that ultimate responsibility for all duties rests with the employer. Clarity around who is doing what is important, as we've had cases where the employer has said that the advisor is submitting the declaration of compliance, and the advisor said, no, the employer is. One thing we know works is nominating yourselves as the secondary contact. This means you are kept informed about important deadlines such as your client's re-enrollment date. We support you through our online guide for advisors, which has the information you need to help your clients with all their AE duties. You can also call our customer support team, and we can speak at client events you may be holding. In line with what you've told us, you wanted more information on in our survey, this webinar will take you through an employer's automatic enrolment and re-enrollment duties, signposting you to the information you need. Finally, we'll walk you through our approach to enforcement. All employers, whether they're individuals or organisations, have AE duties from the day they take staff on, called their duty start date, previously called a staging date. We'll write to the employer confirming their duty start date, but this will be after the employer's duties have already started, so you should ensure your clients are aware of their duties and have started from at least their first payroll run. Within 5 months of their duty start date, employers will need to complete their declaration of compliance, which confirms to us they have met their duties. We have online step-by-step information on what employers must do. The key is leaving enough time to work through the steps. If you have a client who we believe is an employer, but you know isn't, or you have a client who was an employer but has now ceased trading, please let us know using the Not an Employer link. We have lots of information in our online guide on determining who is and is not eligible for automatic enrolment. Also, our previous webinar covered this topic in detail. One area you highlighted in our survey was directors. There is specific information on our website, including when an employer has a choice whether to enrol or re-enroll. You should leave enough time to consider this information so that you can do the right thing for your employer clients. Broadly speaking, if a director is not employed by their company, they are exempt. If they are employed, but no one else is, they are also exempt. However, if another person is employed and the employed director becomes eligible to be enrolled or re-enrolled, the employer may choose not to enrol them. It's important to understand that the employer's choice regarding directors applies only to the duty to enrol and re-enroll, and that all other duties remain unchanged. For instance, they need to be informed that they have the right to join the pension scheme. We will also be answering a video question later in the webinar which will address this point in detail. For more info on direct exemptions, follow the link on the slides to our website. Issuing letters and what to do when staff opt in or out. All employers need to ensure their staff receive timely and correct information about automatic enrolment. This is something you may help your employer clients with. Detailed information about this, including when and how information needs to be communicated, is on our website. You'll find our letter templates, which can be downloaded and customised, invaluable. It's likely the employer's payroll will automatically generate letters at the right time, so you should check this. In our survey, you also asked us about postponement. Again, we have lots of information about this on our website. Employers use postponement for lots of reasons, mostly when they know staff will not be with them for more than 3 months. For example, temporary staff. One thing to remember is that postponement does not change or delay the duty start date or declaration of compliance deadline. It postpones the duty to assess staff. You also need to note that staff can choose to opt in even if postponement has been applied to them. We know lots of you asked about opting in and out. Click the links in the slides to find detailed information on our website. What's important to remember is that employers must inform staff of their right to opt out and how to opt out, and they must not induce staff to opt out. Importantly, the employer or yourselves must not give or send opt-out forms. Not all advisors are aware of this. The opt-out form may only be obtained from the pension scheme provider. You also asked us about TUPE. The most important thing is that TUPE requirements and AE requirements run alongside each other, and the employer needs to make sure they comply with both. Staff transferred via TUPE should generally be treated as new members of staff for AE purposes. I'd now like to hand over to Mel Charles, Director of Automatic Enrolment, who will talk you through re-enrollment.
Thanks, Andy. Let's now talk about re-enrollment and how to avoid common errors. So far, more than 1.2 million employers have successfully completed re-enrollment, and 2 million people have been re-enrolled into a workplace pension scheme. That's why re-enrollment is an important task. It gives staff who opted out a fresh opportunity to save. The hope is that in many cases, staff who are re-enrolled stay in their pension scheme. Re-enrollment also gives you and your clients an opportunity to check all systems and processes are running smoothly. Andy will talk about some of the common errors that can appear in administrative processes a little later. Employers must carry out re-enrollment every 3 years. They do have a 6-month window to do this. They must choose a re-enrollment date which falls within 3 months before or 3 months after the 3rd anniversary of their duty start date. For example, if an employer's duty start date was the 1st of February 2020, they may choose any day between the 1st of November 2022 and the 30th of April 2023 as their re-enrollment date. Once an employer has chosen an initial re-enrollment date, it may be the most straightforward to re-enroll on this day every 3 years onwards. We have a guide which covers the steps you need to take to help your client meet this duty. You can ensure you meet the deadline and avoid common errors by leaving enough time and completing tasks in advance. You should also be clear who is doing what task. For example, is it you or your client completing the redeclaration? In particular, in respect of re-enrollment, you should consider producing a schedule of your client's re-enrollment dates to help manage workloads within the team. Ensure we have up-to-date contact details for the employer. This should be the person who is responsible for carrying out the automatic re-enrolment duties. We often find that these details have changed since the duty's start date, and it's important that we can send information and reminders to the right person. Those who are acting as an agent for their client's duties can nominate themselves as a secondary point of contact. If you have done this, please check your details are up to date. Check if the pension scheme or schemes require proration for members enrolled partway through a period. Most schemes designed to support AE enrolment do not require this. Check if your software or service provider supports re-enrolment. If the pension does require proration, can you pick a re-enrolment date that starts at the beginning of all your pay cycle pay periods? If not, check that your software can calculate the prorated contributions due, or this will need to be done manually. Establish if your client will include or exclude staff that opted out or ceased membership of an AE qualifying pension scheme within the previous 12 months. You or your client will need to issue the staff re-enrolment letters and emails and ensure active membership of the pension scheme is achieved within the 6-week joining window, which starts on the chosen re-enrolment date. Many payroll systems have reports that give the statistical information needed for the redeclaration, such as number of staff re-enrolled and total of those already in a qualifying scheme. Finally, you or your client will need to complete the redeclaration of compliance within 5 months of the 3rd anniversary of duty's start date or the previous re-enrolment date. Use our checklist to ensure you have all the information you need to hand before you complete the redeclaration of compliance. As well as our online guide, you can also access our webinar from last year, which talks through re-enrolment in more detail. The link is in our useful links document. I'll now hand you back over to Andy to cover calculating contributions.
Thanks, Mel. A very important part of an employer's ongoing duties is ensuring the correct calculation and deduction of employee and employer pension contributions. Again, our online guide will take you step by step through what your client will need to do. In most cases, your client's payroll will automatically calculate and deduct the correct pension contributions for staff. However, it's important the data inputted into the payroll system, including ages and earnings of staff, is accurate and up to date. It's important not to be late in paying over staff contributions to the pension provider. Providers have a statutory duty to alert TPR if the employer has not paid or not paid the correct amount within 90 days of the contribution due deadline. If an employer fails to make the correct contributions, it can be costly. As well as the risk of financial penalty, employers may also need to backdate any missing contributions so staff do not miss out. Last year, we carried out a series of spot checks on employers which identified a number of common errors employers make which put them at risk of non-compliance and penalties. One common error employers make is miscalculating pension contributions of staff on maternity leave. While TPR does not regulate statutory maternity leave and pay, we are responsible for ensuring all staff receive the correct pension contributions whether or not they are on maternity leave. Employers should check Money Helper for more information on maternity pay. What's key to remember is that when an employee goes on maternity leave and they are a member of a pension scheme, the employee's contribution will be based on the actual amount of pensionable pay they are receiving during their maternity pay period. The period of up to 39 weeks when they receive statutory maternity pay. However, the employer contributions for this period are based on the pay the employee would have had they not been on maternity leave. Other common errors identified in our spot checks include using the incorrect tax relief method for your employer's pension scheme and not correctly identifying elements of gross pay as qualifying earnings and/or as pensionable pay. It's also important to ensure employer communications are sent directly to staff individually and have the correct information. I'll now hand back to Mel, who is going to talk about how we regulate.
Thanks, Andy. No doubt, the success of automatic enrolment is thanks to the vast majority of employers who have done the right thing for their staff, many of them with the support of advisors like yourselves. However, For the small minority of employers which do fail, we will take enforcement action, including financial penalties and court action where appropriate. We are a data-led regulator. This means we monitor employers and focus our enforcement activity where we detect non-compliance. We monitor employers large and small across all employment sectors. We compare RTI data we receive from HMRC with information we receive through the employer's declaration and re-declaration of compliance. We also receive information from pension schemes which alert us if an employer fails to make the correct pensions contributions. Other ways we detect non-compliance is via our whistleblowing service and other intelligence we receive, for example through our work with other government agencies such as the Pensions Ombudsman and the Money and Pensions Service. We also carry out compliance inspections where we have reason to believe an employer is failing to meet their duties, and we are looking at employment sectors at risk of non-compliance. Mostly, these are sectors with high staff turnovers and lots of temporary and part-time workers, such as hospitality and retail. Every 6 months, we publish data showing where we have used our powers, including the numbers of compliance notices, unpaid contributions notices, and financial penalty notices. You'll see from the bulletin signposted in the slides that we've now completed around 650,000 regulatory interventions. Our actions have also secured payment of over £500 million in late or missing contributions, with over 10 million new savers as a result of automatic enrolment. For instance, we carried out a spot check on a London-based services company with 5,000 employees. We discovered that the employer had failed to redeclare within the required timescales and subsequently failed to provide documentation to show that it had completed its re-enrolment duties. As a result, we issued the employer with a compliance notice progressing to a £400 fixed penalty notice and an escalating penalty notice which accrued to £350,000. We had a follow-up inspection and further on-site meetings to discover how the company was complying with its full automatic enrolment employer duties, which highlighted other failures including incorrect opt-out processes, communication failures to staff, and incorrect contribution calculations. As a result of our intervention, the employer has implemented new processes and procedures to ensure ongoing compliance and that future failures do not occur, re-enrolled over 40 staff and paid over £100,000 in backdated pension contributions covering the re-enrolment failure and incorrect contribution calculations which affected over 2,000 staff. It has also paid the £350,000 fine arising from its multiple failures. As we said earlier, most employers want to do the right thing for their staff and successfully meet their duties. However, we know employers can make unintentional mistakes. Where this happens, we expect the employer to put the error right, including making any backdated contribution payments. If this doesn't happen, the next step we will take is issuing a compliance notice. This will give the employer a deadline to take action to rectify any errors so they can get back on track. Failing to act on this may lead to escalating enforcement action. We don't want to fine employers, but we will where we need to protect savers and ensure staff receive the pensions they are due. Finally, we'll conclude this part of the webinar by urging employers, and you as their advisors, to become familiar with our online guides. We have a guide for employers and more detailed guidance for advisors, and these have all the information you need to avoid making errors and to be compliant. We'll now give you a couple of minutes to submit your questions.
Welcome back, everyone. I can see that we've had lots of questions come in, so I'm going to get started with our first one, and that is from Simon. I keep receiving emails from the pensions regulator about clients that I no longer act for. How do I stop this happening? Mel, I'm going to direct that one to you.
Yeah, hopefully pretty straightforward. If you go to the nominated contact page on our website, you should be able to deselect yourself. I mean, just to let you know, we have been refreshing some of our web pages to make sure that they're more accessible and user-friendly. So actually that page is included in that, and that includes some new functionality to make it a bit easier to delete your details, just bear in mind when you do log in, you'll need the letter code and also your tax references to be able to do that.
Thank you very much. So on to our next question from Julie. Postponement is useful for our clients. When a new employee joins, we usually postpone for 3 months, then enrol in month 4. Some employees' earnings are too low to qualify to be automatically enrolled. Should we only assess them once they qualify and then postpone? Andy, I'm going to come to you for that one.
Okay. So you can postpone people that are starters for up to 3 months, and then obviously you can also postpone individuals who trigger for the first time. And what you're saying here is that you postpone your starters, but actually the person never earned enough to actually trigger to automatic enrolment. So in theory, you could just leave them unpostponed when they start, and when they do trigger, then apply postponement. It's your choice. The employer decides who to postpone and for how long. So it's up to you, really.
Thank you. So our next video has been submitted via video.
Hi, my name's Caroline Burns and I'm the founder of Revive Accounting in Lincoln. Now I deal with a lot of small limited companies, so they maybe have 1, 2, 3 directors, and I'm often asked, do we need to auto-enroll? If we do, why do we need to do it? Under what circumstances? If we take on staff, do we need to auto-enroll? All these kind of questions. And I'd just appreciate a bit of guidance over the circumstances under which a limited company would not have to auto-enroll, and the circumstances under which they would. A bit of guidance would be fab. Thank you.
Okay, thank you very much, Caroline. That's for you, Andy, please.
All right. Okay, yes, good. So directors who are not employed by their company are always exempt. So directors who are employed by their company could be covered for automatic enrolment, but only if there's another employed person, which could be another employed director or member of staff. At that point, those employed people, the employed directors, will come under automatic enrolment. But if you remember in what we were speaking earlier, employed directors, the employer can choose not to automatically enrol or re-enroll them, but they must be notified that they've got the right to opt in. So in this example, for instance, you could have a company with 10 directors, none of them employed. So they're completely outside the scope of automatic enrolment. Then they take a new director on, the 11th director, and that person is employed by the company. And then they take on another director, their 12th director, and that director is also employed. You've now got 2 employed directors, which means that the first and second employed directors come under automatic enrolment, and the employer can choose whether to enrol them or not enrol them, but they must get notified they've got the right to opt in and join the scheme, in which they could choose to do so. The other side of it, of course, is you mentioned about a member of staff. So you could have these directors, like the 10 director company, none of whom is employed, and then you get your first member of staff. As soon as you get your first member of staff, you've got automatic enrolment duties for that individual, and you need to assess them, and if they trigger, you need to put them in the scheme or maybe use postponement, etc. The directors who are not employed are always outside the scope, though. Hopefully that answers that for you.
Thank you very much, Andy. So our next question is from Miriam. What should we do as advisors when a client does not want to engage with automatic enrolment and believes they will not be caught? Mel, can I come to you for that one, please?
Yeah, well, I think we've been as clear as we can be that employers do need to comply with their duties. It's the law. That message hasn't changed even throughout the whole of the pandemic. And our experience is the vast majority of employers are trying to do the right thing, and we provide them as much support and guidance as we can to make sure that they're able to. But there are obviously circumstances where we have employers that don't comply and are determined not to. And I guess the message to those guys is, you are very likely to end up in enforcement action with the regulator. We talked through in the presentation the sorts of steps we take from compliance notice through fixed penalty and escalating penalty notices. But it's also true that we do pursue some employers with criminal prosecution. So if they fail to enrol eligible job holders or provide false information in the declaration of compliance, those are actually criminal offences. And you'll be able to see from our publicity that we have taken criminal cases in the past. In fact, we're pursuing one now with a an employer that's accused of fraudulently deducting contributions from their employees and not paying it into the pension scheme, and they're facing a summons to appear in court very shortly.
Okay, thank you very much. So our next question is from Catherine. As a local authority, we are under a local government reorganisation order. We are the lead employer and our PAYE reference is not changing. We have employees that are joining us under 2P arrangements and so will be contractually enrolled into a pension scheme from our vesting date. Will we be required to submit a declaration of compliance in respect of this? Andy, can I direct this to you?
Yeah, so I think what you're saying is that obviously the local authority area in which you're working as an employer is going under this reorganisation thing. So, and you're saying that you're the lead employer. So therefore you as an employer, by the sound of it, are remaining, and other local authority entities, their employees are transferring into your organisation under 2P. So 2P will have its own requirements. By the sound of it, I think you're saying they'll be put into the local government pension scheme maybe. So when you come to look at what your role is as that employer, then you need to just assess them on the first day that they are employees of you. And if they're already in a qualifying pension scheme, which local government pension scheme is, job done. And that's great, but there's no change of employer for these people. You're still the employer, so there's no need for declaration compliance. On the other hand, of course, if the reorganisation was such that there's a new local government entity created and employees are being transferred from maybe local councils into this new entity, that new entity is a new employer and therefore they will have a duty start date from the first start date of their first person that's been transferred into them, their first employee, and they will have declaration compliance 5 months after that start date. So it all depends what's going on. So if you have got a new employer coming as part of this setup that you're talking about, then they will have a duties start date and they will have declaration compliance responsibilities, but you as the employer will not, because you are continuing as an employer. Yeah.
Thank you, Andy. So the next question is from Julia. If an employee opts out as soon as they are enrolled, does the employer have to refund them straight away in the same payroll run that they were assessed, thus having to reprocess the payroll? Or is it acceptable for the employee to wait until the next payroll? Andy, that's another one for you, I think.
Okay, yeah. It is straightforward. It's simply this, that as soon as, if someone opts out, you should refund their contributions in the next available pay run. So if payroll cutoff has gone by, then it's going to be the following pay run in which they get their refund. I mean, obviously, if you want to reprocess and give them a refund, that's absolutely fine as well. But it is the next available pay run in terms of what we're expecting to happen.
Thank you. So our next question is from Kashfi. I work for predominantly small and micro employers who quite often say that due to their size, TPR will not bother to monitor and identify non-compliance as it isn't worth their while. What can I say to these clients to ensure that they will comply? Mel, I'm going to pass to you.
Yeah, so as a regulator, we monitor, support and take enforcement action against employers of all types and sizes. And I think that's important because, you know, as savers seeking protection from the regulator, you know, it shouldn't be circumstance that they get less protection because they happen to have chosen to work for a smaller employer. So, you know, we are data-led as a regulator. In addition to the data we collect through the Declaration of Compliance, we also get data from HMRC, from the pension schemes themselves, from other intel sources, from other agencies. And we have a pretty good picture of what's going on. And of course, small and micro employers make up, you know, the vast majority of the employer population in the UK. So unsurprisingly, you know, the vast majority of our activity, particularly our enforcement interventions, are actually directed at small employers. You may have seen that mentioned in an article that we contributed to recently in the Financial Times. So, you know, we do put a lot of effort into ensuring that we are regulating the employer population as a whole.
Thank you very much. Our next question is from Annika. We have taken on a new client and have realised that the previous payroll bureau had the wrong tax relief used. So what's the best way to fix this error going back several years? Andy, can I pass that one to you?
Yes, that's not good. I I think, first of all, if it was me, I would speak to the employer, let them know what's going on, then, and almost at the same time, speak to the pension provider, and then decide what the thing to do, what the best steps are. Because first of all, the employee is going to be affected. How are you going to communicate to the employees? When do you change the current payroll going forward to reflect the correct tax relief method? And then what do you do with all the arrears? HMRC are probably going to be involved, because if you've got a relief at source scheme that's been treated as net pay arrangement, you're going to have double taxation relief. And if you've got a net pay arrangement scheme that's been treated as relief at source, you're going to have underpayments. So there's a lot of stuff to be resolved. And the key people to talk to are the employer and the pension provider. And if you get stuck, by all means, contact our helpline.
Thank you very much. So our next question is from Melissa. Would it be possible to have an option online for new payrolls to say none of the employees ordinarily work in the UK and auto-enrolment does not apply? This would be similar to the one for sole directors. There's no easy way currently of explaining why there's no AE on payrolls for expats or direct payment payrolls. Good question. Andy, can I direct to you, please?
Yeah, I can understand your point there. I mean, obviously it is, you're not an employer. So just contact us, either use the not an employer thing or form, or speak to our helpline and just say, we don't have any UK employees. They're all expats. No one's in scope for automatic enrolment. So please, therefore, don't treat us as an employer. And then obviously we can, in effect, stop sending you emails and asking why you haven't done re-enrollment, etc. So yeah, make contact with us and get yourself excluded. I've taken note of that, and I will mention it to the people who look after the website in terms of, is there a possibility of, not just for this, maybe for other reasons why you're not an employer for automatic enrolment purposes. So thank you for that. Thank you.
Great. Our next question is from Ian. I have an organisation that employs temporary fixed contracts for periods of 4 months and are paid twice during that term. What reference period would they be assessed under? Andy, I think that's another one for you.
So temporary fixed contract, 4 months, paid twice during that period. So one of the definitions for pay reference period is the period of time over which you pay your regular wage or salary. So you seem to be paying your 4 months in 2 periods. So what are those periods? So look carefully and decide, is it a 2 monthly or maybe it's a 4 monthly? So you as an employer need to make your reasonable judgment as to what that period of time is, and then you assess them based on that. So if it's, for instance, if it turns out it is 2 months, you've got equal payments each time. So you're just saying, okay, 2 months assessment, that's 2 months qualifying worth of earnings, that's the 2 month trigger point, so 833 times 2, which is 1666. Above that, and they would trigger, maybe you could apply postponement, etc. So it's just a case for you looking at it, understanding what your pay reference period is on that basis.
Thank you very much. So next question is from Zara. The cost of living crisis is obviously having a significant impact on people's finances. Have you seen a rise in opt-out rates over the last few years? And are you worried that people will increasingly be forced to cut pension contributions as increased living costs continue to be felt? Mel, I'm going to direct to you.
Yeah, so we don't collect and publish data on opt-outs. That actually is a role for DWP. You might be aware that their most recent publication was last year, and at that time there wasn't a discernible increase in opt-out rates, but that was a while ago. And I suspect there isn't anybody on this webinar that isn't concerned about the potential impacts of the cost of living crisis, and we're no different. We're monitoring it very closely. We do encourage people to try and stay in saving where they can. Continuity is kind of as important as longevity in terms of saving for retirement. And we do work with the pensions industry and try to get them to refer those people who are thinking of opting out to Money Helper to get some further advice and support. But the reality is there will be some people who can't afford to continue to save into their pension. And for those people, that opt-out is obviously an option that they can exercise. We'll obviously be looking closely at employer behaviours around this, particularly any suggestion that there's some efforts to induce employees to opt out. But otherwise, it's there. And so, for me, then re-enrolment is really there to try and help those people that have opted out. And by the next re-enrolment window, hopefully their circumstances have changed. They'll be put back into the pension scheme, and hopefully they'll decide to stay in and save. But really important that we try and support everybody through this process by providing as much information and advice as we can.
Thank you very much. Our next question is from Tim, and it's on non-UK employers. So how does a non-UK employer, which has a few, even one, remote workers in the UK, but which has no UK bank account and which cannot open a bank account under money laundering rules since it has no presence here, how do we comply with AE in this case? Andy, would you be able to tackle that one?
Yeah. So the employer is not in the UK, but they have got people in the UK who are workers, employees, and therefore are covered for automatic enrolment. So the employer does have to comply with automatic enrolment. There are a couple of pension schemes that do provide pension schemes for overseas employers without a UK bank account. And because there's only two, one of whom is Smart Pensions. So please contact them and see what can be done. There's lots of pension schemes out there, so you could ask other pension schemes to see if they also provide a scheme for a non-UK employer. But you do need to do it, so please have a chat. And if there's no way around getting a UK bank account, then you are limited to just a few choices of pension providers.
Thank you very much. Our next question is from Nolene. Does an employer have to open a pension scheme if all employees are not eligible for auto-enrolment and no employees request to be enrolled? Mel, that's one for you, I think.
Yeah, I think the easy answer is no. If you haven't got anybody who's eligible or asking to be put into a pension scheme, then you don't need to set up a pension scheme. But I think what I'd add to that is it's really important that you have got monitoring set up so that you're looking at the age and eligibility criteria on a regular basis to make sure that continues to be the case for the workforce. And of course, if someone triggers, then you will need to set up a pension scheme and auto-enroll them. Of course, as we said in the presentation, postponement might well be an option in that scenario as well. So no, not at the moment, but do keep them monitoring that carefully.
Thank you very much. So Lauren has asked our next question. As an agent, it can become quite overwhelming when you get letters being sent in by clients saying their renewal is due and yet you can't process it yet. Is there a way to collate all my clients onto my profile or a way to keep a check through the regulator? So Andy, can you answer that one?
Yes, so you should, so bureaus, accountancy firms, etc., where you've got multiple clients, there is a login process where you can have all your clients listed and have all their re-enrollment dates and all that sort of stuff. And you can also obviously nominate yourself as a secondary contact to be notified yourself of the re-enrollment dates, which I think is what you mean by renewal. And you can say to your clients, you don't need to tell me, it's okay, it's all in hand. I know what's going on in terms of I'm being informed by the regulator, and I can look at the website login, I can look at all the ones that are coming up. If you're not sure how to do that, then please contact our customer support and they'll talk you through it.
Great, thank you very much. So Lisa has asked our next question. Will you be able to give any insight into the proposed pension changes in this week's budget? Mel, I'll come to you.
Well, I guess not, in that we won't really know what's in the budget until it's formally announced in the House. But if you're referring to the changes that are being discussed in the press around the lifetime and annual allowances, then really there may well be some employees and savers who've elected to leave the pension scheme and cease saving because of factors like that. They may well then elect to opt in, and employers will need to support them doing that. And of course, at re-enrolment, they may well be re-enrolled and then opt to stay in. So I suspect for automatic enrolment, those are probably the main considerations.
Thank you. So Beta has asked our next question. The automatic enrolment pension should have no barriers stopping an employee from being automatically enrolled. What about a salary sacrifice pension? Is this considered a barrier? an employee must agree to a variation of their contract, and in some instances, pension deduction could reduce their pay below national minimum wage. Andy, would you have that one?
Well, I'll take the last bit first then. So, if you got salary sacrifice in place because that's how the individual's paying their contributions in effect, and that's going to take them below national minimum wage, you can't do that. National minimum wage is a minimum. So if they're in salary sacrifice, you're going to have to put them into normal contributions and take normal contributions from their pay when they're in the scheme. In terms of salary sacrifice agreement being a barrier, then yes, for an automatic enrolment scheme to be the automatic enrolment scheme you use, it can have no barriers. Therefore, any agreement you're going to have with the employee has to be done before they get enrolled. So it could be built into the offer letter. So as they start employment, it's already been agreed that they're going to have a salary sacrifice. Or maybe you're postponing, and during that period of postponement, the individual agrees to salary sacrifice. So whichever way it is, you just need to make sure that salary sacrifice agreement is in place before you automatically enroll that individual into the scheme. And then there's no barrier, and in they go.
Thank you. So Elaine has asked about re-enrolment, and can an employee get a refund the following month if they choose to opt out after they've been re-enrolled? Mel, can you answer that one?
Yeah, so I think probably we covered that in the presentation, or I hope we did, but it operates very in the same way really to enrolment the first time around. So if someone's re-enrolled, they've got a one month window to opt out, and if they opt out, then they should be refunded in the next available pay run.
Lovely, thank you. So Nessa has asked this question. I have a company and I did not do automatic enrolment since the company was incorporated as it was run by a single director. I did not get a notice for the automatic enrolment and the AE did not allow me to do one. How do I solve this problem? Andy, are you able to answer this?
Yeah, so I think you're saying that you are a single director only company, and single director only companies, i.e. it's just you director, are exempt from automatic enrolment. However, it doesn't stop you joining a pension scheme. So please just contact a pension provider that you think would be appropriate for yourself and sign up and have a pension scheme with them and start paying in.
Thank you. The next question's from James. It's quite long, so bear with me. We have a client who has never enrolled eligible employees into a scheme. They became eligible 3 years ago. The employees do not want to be in a scheme and are not happy at the thought of backdating contributions, nor is the employer. So in effect, James's question is, can the employees be enrolled, contributions backdated for 1 month and then cease membership, rather than backdating 3 years of contributions? Mel, I will direct that one to you.
Thank you very much, Leah. So yes, so the first thing to say is don't do nothing. So you will need to take action, or the employer will. They do need to auto-enroll those people into a scheme. There is, of course, as we've discussed, the opt-out window. So they've got 1 month to decide whether they're going to opt out, and if they choose to do so, then there's this refund situation that we've talked about. Obviously, if they don't, then you are into a backdating scenario. And I think the other things just to say on this is just be careful on the opt-out process. It's important that that process happens between the employee and the pension scheme. And the second thing is, obviously in scenarios like this, not suggesting that this is the case here, but, as a regulator, we're very interested then to ensure that those people that are deciding to opt out are doing that of their own free will, and that there isn't any suggestion of inducement. I think that covers it. Anything else, Andy, on that one?
No, that's good, yeah.
Okay.
Thank you. Our next question is from Kamradas. Would the 20% tax relief add to employees' pot every month or year, and can they see the breakdown at any point? Andy, that's for you, I think.
Yes, so obviously this is a relief at source scheme where the individual has money deducted from their pay. That money is paid over to the pension provider by the employer, and then the pension provider contacts HMRC and gets the 20% tax relief from the HMRC, and that money is then paid into the individual's pension pot. The timing of that process is between the pension provider and HMRC, and it could be done on a quite regular basis, or it might be done annually. So, but it will appear in your pension account, and most pension providers nowadays have an online access. So go and log in to your pension account and see and look for that 20% being added back in from HMRC by the pension provider, and you should see it. And you should get an annual statement as well, which will show that, because you should get your bit deducted from your pay plus that top up. And that's your full amount being paid in, as well as the employer. So you should see it on your pension account.
Thank you. So our next question is another video.
Hi, I'm Matthew Acrick, a Policy and Research Officer at the CIPP, the Chartered Institute of Payroll Professionals. And I'd like to ask what steps are being taken or what steps need to be taken to ensure that any changes to auto-enrolment have a minimal negative impact, such as increased opt-outs, reduced take-home pay during a cost of living crisis, or employer costs increasing too rapidly.
Okay, thank you, Matthew. Mel, I'm going to come to you for that one.
So thanks, Matthew. I mean, I think the first thing to say is that the changes that we're really talking about are the changes that we've supported for a long time, which is the recommendations coming out from the review in 2017, particularly around the age and earnings criteria. In terms of when and how they're introduced, that really is a matter for government and the DWP. And you'll have heard ministers talk about introduction in the mid-2020s. In terms of the private members bill that's going through the House at the minute, my understanding is that won't introduce the changes immediately. It provides powers to the Secretary of State to be able to make those changes, and that there's a requirement for a consultation that will look at implementation and timing. So just encourage you to take part in that consultation. But really, exactly when and how these changes are made is really a matter for government rather than the regulator.
Thank you. So Lloyd has asked our next question. Could you please explain the difference between qualifying and pensionable earnings? Hopefully nice and straightforward. Andy, I'll come to you.
Right, so qualifying earnings are defined in legislation as salary, wages, overtime, commission, bonuses, and statutory payments. But you've really got to think anything which looks like one of those is also a qualifying earnings, like shift allowance is a bit like a wage, or it could be a bit like an overtime. So that would fall into one of those categories and would be considered a qualifying earnings. And the idea behind that is that you add up all those payments, all those qualifying earnings to get a total. And then along with the person's age, you then assess them. And if they're an eligible job holder, because they're earning over £833 a month, £192 a week of qualifying earnings, and are between 22 and state pension age, eligible job holder, you could postpone. Otherwise, you're going to automatically enrol them into a scheme. So qualifying earnings are key because that's the amount you use to assess if someone's gone above the trigger to be automatically enrolled, or whether they're a non-eligible job holder, someone who doesn't trigger automatic enrolment, but earns enough so that they can opt into a scheme, and then there's an employer contribution due. So the qualifying earnings is important in that respect as part of the assessment process. Pensionable pay, on the other hand, is a bit like this. So automatic enrolment puts you into the pension scheme. When you're in the pension scheme rules, terms and conditions take over, and those rules, terms and conditions will define what is pensionable pay. So it could be basic pay only is pensionable, or basic pay plus overtime is pensionable, maybe from pound one upwards. Or it could be that pensionable pay is also qualifying earnings between the low and upper threshold. So you need to know both. You need to know that qualifying earnings is going to put you into a scheme, it's part of the assessment process, and pensionable pay is what you're going to pay contributions on. So you need to understand both. So you could have a payroll system where you've got a list of all your payment elements, and you're going to have, as well as like basic salary, taxable, deniable, pensionable, qualifying earnsable, shift allowance, taxable, deniable, pensionable, qualifying earnsable, and so on. So you just need to make sure you've got all of them identified. Some may not be, like first aid allowance. Is that qualifying earnings or not? You need to make a reasonable judgment. And if you decide it isn't, then you would just leave it as taxable deniable, for instance, and it's not qualifying earnsable, but maybe the pension scheme says it is pensionable, in which case you'd have to treat it as pensionable. So the two are separate, but can be the same if your pension scheme defines pensionable pay as qualifying earnings.
Okay, thank you very much. So Hayley has asked our next question. Do employers need to pay normal employer pension contributions for the period of unpaid maternity leave, or is it just for the first 39 weeks? Good question. Andy, I'm going to direct to you.
Yes, the 39 weeks the employer pays based on the pay that the individual would have had. The unpaid period, the bit from the 40th week to the 52th week, that the end bit, the unpaid part, that there's no requirement in terms of a minimum contribution to be paid by the employer at all, unless as an employee contractually you've agreed to pay contributions, or the pension scheme rules require you to pay contributions. So we're talking about this is the minimum employer contribution due for those 39 weeks, but you really got to look to see what your contract says in terms of contribution rates and also what the pension scheme rules require. So normally there wouldn't be any contributions, we just need to check in case there is.
Thank you. So our next question is from John. If I have one company within a group with a different re-enrollment date, how can I get that date changed to align with all other group companies? Mel, would you take that one?
Yeah, so it sounds like they've been through re-enrollment once before. So once you get to your third anniversary, you've got the 6-month window that we talked about in the presentation. So 3 months prior and 3 months post that anniversary. So hopefully, if the other companies are using any of the dates in that 6-month period, there's an opportunity to align. Beyond that, I don't know if there are other opportunities to do that, Andy. I think that might be it. So hopefully that works for them. But I think that's probably their only opportunity.
Okay, thank you. And we've got time now for just a couple more questions. So we're going to go with another maternity question. If an employee is on maternity, does the employer need to pay contributions based on what they would have received? And what if they are on a 0-hour contract? So that's another good question. Andy, can you answer that one?
Yeah, so yes, so the employer does need to pay within those 39 weeks. So when the person's getting SMP, they need to pay based on what the person would have had they not been on maternity leave. And of course, that's quite nice if you just happen to have a standard monthly salary, because that's going to sort of like be the pensionable pay you're going to use for the employer contribution. But when someone's on 0 hours or just got variable pay, overtime and lots of other things going on, then how do you calculate what the amount of pay the person would have had they not been on maternity leave? Well, legislation doesn't really define it. But you do use a method of calculating what the person's pay is in order to determine what the high rate SMP is. So maybe you could use that 8-week pay the period of time, 15-week prior to the 26-week. You know the rules behind SMP. You could use that, or maybe you think actually, the government have introduced the holiday pay entitlement. The 52 weeks in the past 2 years average. So you just need to determine a way of calculating what an average pay would be for that person, and using some of the current alternative ways of establishing an average pay is a logical thing to do, and then utilize that and then start calculating employer contributions using that result that you've calculated.
Thank you. So this is our final question. And it's from Caris. Should we be communicating to staff who are not eligible? So those younger than 16, for example. And Mel, I'll pass that one to you.
Yeah, well, I suppose there's sort of reasonably extensive guidance, including example communications on the website for you to make use of about exactly who you need to communicate with and when. Obviously, we'd throw the net wide in the regulator as supporters of AE and say, look, you want to be talking to all of your staff about saving for their retirement, regardless of which of the various sort of buckets of eligibility and entitlement that we've talked you through in the presentation. But I think probably too long an answer to step you through each individual category. But I think, hopefully the age and eligibility criteria that we've talked you through directs you to the right sort of communications to use. You got anything to add to that one, Andy?
Only that there's no requirement to send a letter to someone under 16, but when they get to 16, you do need to write to them within 6 weeks of their 16th birthday to say you've got the right to opt in or join. So, and maybe it's nice to give them some information before that.
I think it comes back to our earlier point, which is, even if you have people who aren't falling within the sphere of automatic enrolment immediately or one of the other categories, it's really, really important to keep set up and monitoring the staff, particularly as they move through and earn different amounts or ages change, to make sure that you don't miss out and when they should be receiving benefits.
Okay, thank you very much. So that was the last question that we have time for. I'd like to take this opportunity to thank you all for joining us today and for sending in your questions. I hope you found the session useful and informative. And as mentioned earlier, the slides will be made available to download after this webinar, along with our useful links document. And a replay of this webinar recording will be available in a few days by navigating back to this page. We really appreciate your feedback, so please do complete the survey and have your say. And as a reminder, you can find this in the menu to the left, and it will now also have popped up in the box on the right. And so now it's goodbye from us all.